Stick around, because in the next 10 minutes, I'm going to show you exactly how a simple strategy called CD laddering can help you lock in higher rates before they disappear, keep your money safe, and still give you access to your cash when you actually need it. No stock market risk, no confusing investments, just a smarter way to park your money. Let's start with the basics. A CD, or certificate of deposit, is basically a savings account with a deal attached to it. You agree to leave your money with the bank for a set period of time, maybe 6 months, maybe 2 years, and in return, the bank pays you a higher interest rate than a regular savings account. That's the trade. You give up flexibility, they give you better returns. Now here's why this matters so much right now. The Federal Reserve has been cutting interest rates, and when that happens, banks start lowering what they pay you on savings accounts almost immediately. We're talking within days sometimes. But CDs are different. When you lock in a CD rate today, that rate is guaranteed for the entire term of the CD. The bank cannot change it on you. So while everyone else watches their savings account rates slowly shrink, you're sitting there earning the higher rate you locked in months ago. The catch is that most people hear the word CD and immediately think, well, what if I need that money? And that's a completely fair concern. But here's the thing. There's a strategy that solves exactly that problem, and it's called a CD ladder. And once you understand how it works, you're going to wonder why nobody told you about this sooner. A CD ladder is not complicated. The idea is simple. Instead of dumping all your money into one single CD with one maturity date, you split it up into several smaller CDs that mature at different times throughout the year or over several years. That way, you always have money coming due soon, which means you always have access to some of your cash without penalty. Here's a quick example. Let's say you have $10,000 you want to put to work. Instead of putting all $10,000 into one 2-year CD, you divide it into 5 equal pieces of $2,000 each. You put the first $2,000 into a 3-month CD, the next $2,000 into a 6-month CD, then a 9-month CD, then a 12-month CD, and finally, a 24-month CD. Now, every few months, one of those CDs matures, and you get that money back with interest. When each CD matures, you have a choice. If you need the cash, take it. If you don't, you roll it into a new CD at whatever rate is available at that time. This keeps the ladder going and keeps your money earning interest continuously. The beauty of this is that you're never completely locked out of your money for too long. And in a falling rate environment, the longer-term CDs in your ladder are protecting you because they locked in higher rates before rates dropped. That's the whole game. But how do you actually build one of these ladders? Let me walk you through it step by step. Building a CD ladder is something you can do in an afternoon. Here's how to approach it. First, figure out how much money you want to put into your ladder. This should be money you don't need for emergencies. Keep your emergency fund separate and liquid. The money going into your CD ladder is money you can afford to set aside for a while. Second, decide how many rungs you want on your ladder. A simple 5-rung ladder with maturities at 3, 6, 9, 12, and 24 months is a great starting point. You can go longer if you want, but this structure gives you flexibility while still capturing solid rates. Third, shop around. Rates vary a lot between banks, especially between traditional brick-and-mortar banks and online banks. Online banks almost always offer higher rates because they have lower overhead costs. Look at sites that compare CD rates across multiple banks so you can find the best deal without opening 15 different browser tabs. Fourth, open the accounts. Yes, this means opening accounts at different banks potentially, but it's worth it for the rate differences. And everything is FDIC insured up to $250,000 per bank, so your money is protected. Fifth, set a calendar reminder for each maturity date so you don't miss it. When a CD matures, there's usually a short grace period, often around 10 days, where you can decide what to do with it before the bank automatically rolls it over at whatever current rate they feel like giving you. Don't let that happen by accident. Stay in control. Now here's something important most people overlook when building their ladder. The biggest mistake people make with CD laddering is building it and forgetting about it. When your CDs mature, the bank will often roll them over automatically into a new CD, but not necessarily at the best rate. You need to be proactive. Check what rates are available when each CD comes due and decide whether to stay with that bank or move your money somewhere paying more. Another common mistake is putting money in that you might actually need. If you break a CD early, you typically pay a penalty, which can wipe out some or all of the interest you earned. Before you build your ladder, make sure you genuinely have a fully funded emergency fund sitting somewhere accessible, like a high-yield savings account. People also underestimate how much the rate difference matters over time. The difference between earning 3% and 5% on $20,000 is $400 a year. That's real money. Shopping around for even slightly better rates is always worth the extra 30 minutes. One more mistake to avoid is ignoring shorter-term CDs in a falling rate environment. Yes, longer-term CDs lock in high rates longer, but having some shorter-term rungs means you have flexibility. If rates somehow went back up, you'd have money maturing soon that you could reinvest at higher rates instead of being locked out entirely. Balance is the key, and that balance leads us to the most important question you're probably asking right now. A CD ladder is not for everyone, but it works really well for specific types of people. If you have cash that you want to keep safe, earn a predictable return on, and access periodically without panic, a CD ladder fits that goal perfectly. It works great for people saving for something specific in the next 1 to 3 years, like a down payment on a house or a car. It works great for retirees who want steady, predictable income without market risk. And it works great for anyone who just wants their cash working harder than a regular savings account without touching the stock market at all. The rates available right now are still historically solid, but that window is closing. Every time the Fed cuts rates, banks lower what they offer on new CDs. The people who locked in 6 months ago are quietly winning. The people waiting are quietly losing ground. You don't need to be a financial expert to do this. You need a few hours, some comparison shopping, and a basic spreadsheet, or even just a notes app to track your maturity dates. If this video helped you understand CD laddering, do me a favor and hit that like button right now. It helps more people find this kind of straightforward money content. Subscribe if you want more videos like this one, because we cover simple strategies to make your money work harder without unnecessary risk. And drop a comment below telling me how much cash you're currently sitting on that could be in a CD ladder. I read every single comment, and I'd love to hear where you're starting from.